Good morning and welcome to topic 4 of your economics course. Topic is about financial markets. These are the objectives of the course, and I'm not going to talk you through the objectives because this is really what you come back to. However, and having said that, what you do want to do, what I do want to do, and what the key objective of this whole thing is, what you want to take away with you, apart from educating you about monetary policy, how interest rates are controlled, the different kinds of interest rates, etc., etc. The real thing that I want you to take away from this course is how to forecast interest rates. That is important for you at a personal level. If you want to buy a new apartment or a new car, you need to know the outlook for interest rates if you're going on credit. At a corporate level, you also need to understand the outlook for interest rates, because if you're going for a merger or an acquisition, clearly you need to understand the outlook for interest rates. Even if you're simply looking at business as usual and you're looking at your leverage, if, for example, you're highly leveraged and interest rates go up, you could be bankrupt. So the thing that you take away from this section of the course is how to forecast interest rates. And we do this in two ways. We do it by thinking carefully about interest rates and the factors that central banks take account of when they want to forecast interest rates on the one hand. And we also look at capital markets, and we use capital markets and we use long bond yields as a mechanism for forecasting interest rates. These are the key issues that we're going to do. I'm not going to talk you through them. These are the hyperlinks, and so you can move easily through the course or through the section of the course. And where I want to start off with then is to go through the introduction to this course and to take you to where we are in the course. Where we are in the course is we have introduced the circular flow. So we have households on the one hand, we have firms on the other hand, we have the generation of income from firms to households as they produce goods and services, and similarly we have the expenditure that results from increases in income. We've also looked at prices and markets, so we can now introduce prices and markets into the circular flow. So what we have on the right-hand side is we have what is called the product market. Effectively, this is the retail market. It's the interface between households and firms. So it's the product market. And this is a very simple supply and demand curve. But in effect, because we're dealing here with all households and all firms, and we're dealing with total income and total expenditure, this in fact now is aggregate supply. And for more of that, please go back to the topic 2 of this course, where we looked at topic 3 of this course, where you looked at prices and markets. And we saw then from a macro perspective that we have aggregate supply, and of course we have aggregate demand. What this also means is that the horizontal axis is not quantity as in quantity of shoes, but it's quantity of all goods and services, and therefore it's GDP. The vertical axis is not the price of shoes, it's the price of all goods and services. So as the price level changes, for instance, as prices increase or as prices decrease, you can think about this as the inflation rate. It's not absolutely correct, because the inflation rate is effectively the rate of change in prices, whereas this axis here is the price level. But I think for the purposes of what we're trying to do together, one can think about this as the inflation rate. So therefore, as the price level drops, we can infer that the inflation rate is slowing, or as price levels increase, obviously we can infer inflation is increasing. The other market that we introduce into the diagram now is the factor market, which is the market for factors of production. There are 4 factors of production, you will recall. There's entrepreneurship, labor, capital, and land. I'm drawing this particular diagram here is the labor market, with the price of labor being wages. So we have wages in the vertical axis, we have demand for labor, we have supply of labor, and we have quantity of labor. So that is where we are in this course. Now we introduce financial markets. And what financial markets do is they take savings that come from households, they take savings that come from firms, and they channel that funding back into the economy as loans to households, overdrafts, student loans, etc., and loans to firms, working capital, expansion capital, and so on. You will recall that one of the factors of production that we have coming from households down to firms is capital. And we, at that time in the course, we spoke about that capital as being savings. Well, now we can see that more clearly because, of course, there's your capital. So there's your savings going into financial markets, and it gets channeled back as loans either to households or to firms. At the level of the firm, we would refer then to that loan as an investment, which is funds coming from financial markets into firms. And again, when it gets used as expenditure, so when we buy vehicles, when we build roads and things of that nature, it becomes investment here in the product market, and it sits in the equation where total expenditure is equal to C plus I plus G plus X minus M. This is the I part of that equation. So consumption plus investment, that is that investment there. At the moment, this is just money. It's just a loan. It's not yet buying of vehicles and building of roads. And now we have financial markets. So we now put financial markets into the circular flow. And clearly this diagram is a very simplistic diagram. And we need to have a look at the detail that lies behind this diagram. So to introduce that detail to you, we now make a distinction between different types of financial markets. So the first distinction I want to make between different kinds of financial markets is the distinction between what is called a money market and a capital market. The simplest way of understanding those differences between money markets and capital markets is a timescale difference. So the difference between the markets is a timescale difference. And effectively, your money market is a market for short-term borrowing and short-term savings. A savings account is a short-term saving. An overdraft is supposed to be a short-term saving. It's not supposed to be a permanent feature of your life. And whereas in a capital market, it's a market for long-term borrowing and long-term savings. Long-term savings, pension funds, retirement provision on the one hand, and where firms borrow long-term, they're borrowing for expansion capital or working capital or equity and things of that nature, so long-term borrowings. The capital market in turn, so this capital market here, where the laser pointer is, the capital market in turn has got two sub-markets, and those are what's called a long bond market and an equity market or a share market. And again, the simplest way to understand the differences between these two markets is to understand the instruments that are traded in the markets. When we refer to instruments, we simply mean the financial paper that lies behind the market, the debt instrument. So an instrument in the easiest way to think about an instrument, it's some sort of IOU. And this is particularly the case in the long bond market, where the long bond market, the instrument that's traded, the piece of paper that changes hands, is a debt instrument. I owe you lots of money and I will pay you sometime in the future, whatever the term structure of that debt instrument happens to be. On the other hand, the instruments that are traded obviously in the share market or the equity market is a share certificate. Clearly in today's world, that's a dematerialized share certificate. It means you don't actually get a piece of paper. It's electronic entry, but it remains in people's minds as a share certificate. It's not an IOU in the true sense of the word, but it certainly is your long-term loans which have been made to a company, which is long-term borrowing on that part of that company. In the long bond market, there are two sub-markets. And those two sub-markets now are the primary market and the secondary market, again where the laser pointer is. The primary market is the market where a new bond is issued. So, for example, where the government of the Netherlands needs to borrow money to build a hospital, that would be a primary issue. So a new bond is created by the government of the Netherlands. The new bond is sold to the bond market. That is a primary issue. The only other time that the primary market becomes important is when that bond is redeemed at maturity. In other words, when the government of the Netherlands has to pay the bond back, and that bond repayment occurs in the primary market. That is not really of much importance for us in this course. What we are much more concerned about in this course is the secondary market. And the secondary market is where the bonds that have been sold in the primary market, where the bond market has bought a bond from the government of the Netherlands, that is where that bond can be traded within the bond market. So as you can see, it's the sale and purchase of existing bonds, whereas this one, where the primary market is the sale and purchase of newly issued bonds. The secondary long bond market is of key importance in our conversation, because when you want to forecast interest rates, which is the thing that you want to take away with you from this course, when you want to forecast interest rates, you look at the yield in the secondary long bond market. For more of that later. Now, before we start carefully on the discussion we're going to have, I think it's very important to lay out that the terminology we're going to use is generic terminology, and that it's important to appreciate that different countries have different definitions, they have different institutions, they have different types of money, they have different measures of money supply, they have different banking systems, and they even have different ways of doing monetary policy. So what I have to do is to give you an overview of generally how money works, what money is, how banks work, and as a result I have to follow a generic approach. My generic approach will very often be different to the specifics of a specific country. We continue now, and we now get very specific in the discussion that we're going to have, because the first part of the conversation we now want to have about financial markets is about money markets. And the entry level discussion, the simplest way that we have of discussing money markets is to discuss different types of money. Now, you know as well as I do that there are many different types of money, and that money is what people will accept as a means of exchange. The thing that distinguishes different types of money is the degree of liquidity. In other words, how easily is whatever we want to use as a means of exchange convertible into cash. So in order to understand this, and to use the analogy that we use in lectures, let's go shopping. And let's shop until we drop, and let's spend all of our money. And the way we're going to spend the money is from the most liquid money to the least liquid money within the bounds of sensibility for this conversation, on the one hand. And the second thing, and we'll see the reason for this later on, is you can only spend your own money. You can't spend money that belongs to somebody else. In other words, you cannot use debt as money in this context. And we'll see again later on why that is the case. So let's go shopping. Let's shop till we drop. And we spend our most liquid money, which is obviously cash, because that is the most liquid of all money. So now your cash is depleted. And the next type of money one would reach for is typically what is debit card. A debit card in the jargon of economics is part of a demand deposit. And a demand deposit is a type of banking account where you can go to the bank and you can demand your money. So it's a demand deposit. A debit card is the obvious example of that. In some countries they're called call accounts, but you can go in and you can demand your money. The next type of money that we would then use is a savings account. And in fact, a savings account is in fact a 1 month notice account. So banks, if they wish to, they can impose a 1 month limit on you drawing from a savings account. They typically don't. They can. And if there's a run on the bank, they will. So savings accounts are less liquid, at least in theory, than demand deposits, and in some countries in practice are less liquid. And then finally, the last of the measures that I want to deal with here are fixed deposits, or so-called time deposits. So a 2-month fixed deposit, a 3-month fixed deposit, and so on. The list will continue. So below this, for instance, we will get things like bankers' acceptances, you'll get NCDs, we'll get bills of exchange, we'll get transfers of various kinds, we'll get short-term treasury bills, we'll get short-term government bonds, we'll get longer-term government bonds, etc., etc., etc. I don't want to go there, but what I want you to appreciate is that these exist, and the different types of money makes for an understanding of money actually a very complex understanding of money. And if you can cast your mind back to topic 1 and the very first conversation we had together, when we introduced and we discussed what we called Economics 101, where we had a pile of money and a pile of things, I deliberately tried to make you visualize the pile of money as a pile of cash. Now you need to visualize that pile of money not as a pile of cash, but as a pile of all these different kinds of money, including all of the stuff which is below here that we don't want to have a conversation about. Which means that in Economics 101, which has now suddenly become Economics 201, the pile of money has become a lot more complicated. And if you can visualize that pile of money as being a small amount of cash in the top, then demand deposits, etc., etc., central banks now need to know how much money is available. How much can we spend? And the challenges they've got now, you will appreciate from this diagram, is that we can spend all sorts of different money. And the different money, what distinguishes the different kinds of money is the degree of liquidity. So when you go to now what is now called Economics 201, and you think about your pile of money, the most liquid is cash, followed by demand deposits, etc., etc. So we need measures of money supply that can take into account this degree of liquidity. And these are the so-called M measures. And this is the first area where we have country differences. So this is a generic conversation. So the measures, the first measure that I want to use is called M1, and it's a European measure, where M1 is measured as cash in circulation plus demand deposits. Now, I know I'm being pedantic here by this thing called cash in circulation, but it's important because when we refer to cash in circulation, it's obviously cash moving between people and retail outlets and things of that nature. When cash is not in circulation, cash is in the vault of a bank. So the cash that we will talk about is cash which is outside of the banking system. That is cash in circulation. If the cash is in the vault of the bank, it's not cash in circulation. And the reason we're doing that is that if you deposit cash into your debit card, the buying power is in your debit card, the cash is in the vault of the bank. If you then use your debit card and draw out the cash, you've lost buying power from your debit card, and the buying power now is in the cash in your wallet or your purse. That's the reason for the distinction. The second measure of money supply is called M1. These are cumulative. So if you go back to Economics 201, we're not measuring the slices of the pile of money. We're measuring the cumulative buying power of the pile of money. So M2 now includes M1 plus what are called short and medium-term deposits. These, in this particular definition I'm using, are up to 2-month fixed deposit, so a 60-day deposit, a 2-month fixed deposit. And the final measure that I want to use is M3, which again is cumulative, so it includes M2. And these are what are referred to as long-term deposits, but are in effect 90-day or 3-month fixed deposits. That's as far as I want to take the conversation. However, in most countries, this measure of M supply continues down to M10, to M18, to M25. So if you go back to the previous slide and you think about the different types of money, when we start getting to M10 or M18, you'll begin to appreciate now just how complex in Economics 201 our pile of money suddenly has become. There are additional readings here here for you to read further on this. Okay, the reason for setting up this part of the conversation is to go to the next slide. This is money supply in Europe. And you'll see that what you've got in this money supply is that this is M1, so it's cash in circulation plus demand deposits. There's M1. This is M2, And finally, that's up to 2-month fixed deposits. And finally, this is M3, and you can see them over here. So that is the composition of your money supply. One of the things that I want you to recognize immediately from this diagram is just how small cash in circulation is relative to all these demand deposits. If we do the same thing for Australia, which is a more graphic example of the same issue, in Australia, you'll notice that there's no M2 in Australia, so we have a definitional difference here. But the point that I'm trying to make with this diagram is that if you look at cash in circulation is very small compared to the deposits in M1 and compared to deposits in M2. So again, what I'm emphasizing is just how small cash is in the scheme of things. And finally, if you do the same thing for Japan, you'll see again a very similar picture emerges. And again, notice here in Japan, we have these different definitions of what's happening of different kinds of money. So away from the generic stuff, that's not the point I'm making. There's your currency plus M1 plus M2, etc., etc. And again, the emphasis here is on how small currency is. So what we have here is we have money, and in order to understand this, the currency is issued by central banks. All of these deposits that you have here are the consequence of what banks, commercial banks, do. So therefore, if we want to understand money, we need to understand banks. And that's where this conversation now goes to. The purpose now in the conversation we're having is to understand when we look at M3, or even when we look at M1, why cash in circulation is so small and demand deposits are so big. Just a word of warning, or in fact, not so much a word of warning as a challenge that I've got right now in this particular recording is that in PowerPoint, when you record a lecture, you can't use hyperlinks. And you'll recall from the lectures that in this part of the course, there's a lot of hyperlinks that get used. So unfortunately, I can't use the hyperlinks and jump between different slides. So this particular part of the narrated lecture is less fluid than in the lecture where I jump between slides. So you need to forgive me. I need to go through a slide and complete the slide before I can go to the next slide. I can't jump around between slides, but you can cope with that. So the purpose of the exercise then is to understand money and money supply. And you'll recall from the lectures, we went to a much nicer place. We went to some lovely island, and we want to use the island to understand the money creation process, how banks create money. So we start off, we have a commercial bank on the island, and the commercial bank sets a reserve requirement. The reserve requirement on the bank is a voluntary reserve requirement. In other words, the banker wants to keep money in the vault and lend the rest out. The bank is keeping a 20% reserve requirement in this particular case. You'll recall in lectures that what we did at this particular point was use the hyperlink on that word reserve requirements to go and look at reserve requirements in the rest of the world. I can't use that right now, but in a moment, once we finish this particular slide, we'll have a look at those reserve requirements. So it makes this recorded lecture a little bit lumpy, but again, we have no choice here. So what we want to do is understand the arrival of money. So money arrives in the island in a boat, and it just happens to be an MBA graduate, as you'll recall. The MBA graduate in the bottom of the boat are 1,000 euros. The money is deposited into the bank, and the graduate parks out on the beach getting a bit of a tan, if that's the sort of thing you're into. Getting a bit of a tan in today's world is probably not a good idea, because getting a bit of a tan actually is the beginning of skin cancer, so don't do it. If you do, use sunblock. So the money is deposited in the bank. The bank, and we'll look at the balance sheet in a moment, but in your mind's eye, if you can visualize it, the bank will keep back a portion of that 1,000 euro deposit, 20%, 200 euros, and will lend the rest out. And the loan is being made to the local fisherman, or if you want to be gender neutral, a local fishing person. So 800 euros are given to the local fishing person. The fishing person in turn takes the money, goes along to the fishing tackle shop and buys some bait, which I'm told is very good for fishing, and also buys a really cool hat, which helps you not get skin cancer. And then the owner of the fishing tackle shop takes the money and puts the money back in the bank. When we get to the balance sheet, we'll see how the money supply changes. To finish this particular slide, we will look at the bank become fully loaned up in the balance sheet. Once the balance sheet is fully loaned up, we then have a situation, and we want to now destroy this banking system, where what happens is that the MBA graduate goes along to the bank, draws out the 1,000 euros, and sails away, never to be seen again. And moments later, the owner of the fishing tackle shop comes into the bank and wants 800 euros in cash. What does the bank manager do? Gets his own boat and sails away. But obviously we can't do that in the real world. So because what the bank manager faces is some very big and personal injury of some form or other. So the MBA graduate, having done an ethical MBA, does not sail away. Rather, what the MBA graduate does is goes to the bank and gives the bank 30 days notice. In other words, the graduate says to the bank manager, in 1 month's time, I will sail away. What does the bank manager have to do? Now, this is a very small island. Everybody knows what's going on. Everybody knows that the graduate is going to sail away. Everybody knows that the bank manager has no money. And that's very true of a national economy as well. So the only thing the bank manager can actually do is call in loans. And the loan that gets called in is the loan to the fisherman. Clearly, the fisherman doesn't have the 800 euros because that is funding which is going to be paid off over time. So we foreclose on the fisherman and we sell his stuff. We sell his hat and we sell his bait and we sell all the rest of it. But that is not sufficient to cover the 800 euro loan. The consequence of foreclosing on the fisherman now, it's not just the fisherman, it actually is the island's fishing industry that has now been put out of business. And the consequential or systemic damage as a result of putting the fishermen out of business is to put the entire marine supply business out of business. So all the shipbuilders, all the ship repairers, all the suppliers of goods and services to the fishing and the maritime industry now goes bankrupt. And sooner or later, the bank itself goes bankrupt, and the thing that disappears is the island pension fund. We're now going to go backwards a little bit because of the nature of the PowerPoint and that I can't use the hyperlinks. So just to look very quickly at reserve requirements now. These are reserve requirements. So in these years here, you can see the different reserve requirements. In the UK in the 60s was 20% reserve requirement, which declined over time. Germany, again, close to 20%, which declined over time, and so on, although India in this particular case has gone up. If we look in today's world, these are the reserve requirements. So you'll see in Australia, New Zealand, and Sweden, there's a 0 reserve requirement. Eurozone, there's a 1% reserve requirement, meaning if you deposit 100 euros in a European bank today, they keep back €1 and they lend out 99. If we look at Chile, it's 4.5%. In Nigeria, it's 20%. And if we just keep running this thing down here, Brazil is 45%, which indicates how fragile that banking system is as we speak, and so on. That's really a digression from the main thing. So we come back now to our balance sheet. So this is the mirror image of what was happening on the island, the picture of the island. So when the graduate arrives on the island, the first balance sheet that we see is balance sheet number 1. And what you see is that is that original deposit from the graduate into the island. It's a liability to the bank manager because the bank owes that money to the graduate. The bank manager in turn has an asset against that, which of course is the cash. And one of the things we want to track, and one of the objectives of doing this particular exercise, is to understand, when I look at M3, why cash in circulation is so small, why deposits are so big. Because if you look at the value of M1 now, it's 1,000. If you go back to the definition of M1, M1 is defined as deposits plus cash in circulation. There is no cash in circulation because all of the cash is in the vault of the bank. So this M1 here is this 1,000 here. It's the demand deposit, and there's no cash in circulation. The banker now rearranges the balance sheet so that the liability side of the balance sheet remains unchanged. The banker holds a reserve, a 20% reserve against that deposit, and lends the rest out. That is the loan to the fishing person. So the consequence of that is that in terms of M1, M1 is now this demand deposit plus the cash in circulation. So M1 is now 1,800. And the purpose of this exercise is to understand, when I look at M1 or M3, why cash in circulation is so small and deposits are so big. And you can immediately see this is why it's happening. Because banks get a deposit into the bank, they keep back a portion as a reserve, they lend the rest out, the money circulates. But what the bank is doing is increasing the buying power, has increased the pile of money. This is the fisherman's loan. The fisherman goes to the fishing tackle shop and buys some bait and a hat. And the owner of the fishing tackle shop comes in and deposits that money. So this is the balance sheet after the deposit from the fishing tackle shop. So we have the deposit of the graduate, the same 1,000 as we have here. The black in the diagram in this balance sheet is the same as the black in balance sheet 2. This is the deposit from the fishing tackle shop, and this is the corresponding cash that the fishing tackle shop has deposited. If we look to cash in circulation, if we look to where the cash is there, the 200 is cash and the 800 is cash. So all of the original deposit is now back in the vault of the bank. It's 200 in reserves, 800 in cash in vault. As a result, there's no cash in circulation, and your M1 is now deposits, which is the 1,800. So you'll notice that between balance sheet 2 and balance sheet 3, the value of M1 is unchanged, but the composition of M1 has changed. In balance sheet 2, M1 was made up of demand deposits plus cash in circulation. In balance sheet 3, M1 is made up of demand deposits, these 2 demand deposits, and there's no cash in circulation. The banker now again rearranges the balance sheet. So now we have deposits of 1,800, against which you must keep a 20% reserve, which obviously is 360. The place that the bank gets the additional funding from is from this cash that came in. So I had a reserve of 200. I need to increase my reserve to 360, so I need an additional 160 euros to do that. I take the 160 from the 800, so that tops up my reserves. And what's left of the 800, the 800 less the 160, of course, the 640 is now loaned out. That again becomes cash in circulation. So the consequence now is that M1 is made up of this demand deposit plus this 640, which is cash in circulation. Of course, the sum of those two numbers is 2,440. This process will continue until the bank becomes fully loaned up. So we move to the final balance sheet. And at the level of the final balance sheet, the one thing that stops this money creation process is the extent of the initial cash deposit. Because if you look at this initial cash deposit and you follow the cash deposit, where's the cash deposit going? It's going to reserves, it's going to reserves, it's going to reserves, which we haven't shown here, etc., etc., etc. So the final balance sheet has to be a situation where all of the original deposit is being held in reserves. At that point, the bank does not have any more reserves to lend out, and the bank then becomes fully loaned up. It cannot make any more loans. With a reserve requirement of 20%, it means that the bank can now hold deposits of 5,000. So this 1,000 here is 20% of the 5,000. That's the deposits the bank can hold. And of course, how many loans did the bank give out? Well, balance sheets always balance. The bank gave out loans of 4,000. When we get to this final balance sheet, the value of M1 is 5,000. If you look at the composition of M1, the composition of M1 is made up of demand deposits, 5,000, and there is no cash in circulation because all of this cash from the original deposit is being held here as a reserve. So you have deposits of 5,000, zero cash in circulation, and we have therefore M1 of 5,000. And at that point, the bank is fully loaned up. One of the key issues to recognize here is that in order for the bank to have gotten to the position where it's fully loaned up, it has created loans of 4,000. But the only way that the loans become deposits is if the loans are actually used. Go back to balance sheet 1. At balance sheet 1, the banker actually has the facility to go from balance sheet 1 to the final balance sheet by issuing a loan of 4,000, because the banker knows that a deposit of 1,000 has come in. The banker knows, the banker can see in the vault that there's cash of 1,000. The banker knows that this 1,000 can be used completely as a reserve, and therefore the bank actually can jump from balance sheet 1 to the final balance sheet simply by giving a loan of 4,000. But in order for this loan of 4,000 to appear on the balance sheet of the bank, on the one hand, and in order for the loan to come through as a deposit, the loan has to be used. If the loan is not used, the banker simply stays at balance sheet 1. So let's do it. Imagine at balance sheet 1, instead of giving the fishing person a loan of 800 euros, rather you give the fishing person a line of credit of 4,000 euros because you know you can give that line of credit of 4,000 euros. And the fisherman, the fishing person, does not use the loan. We stay at balance sheet 1 because it's just a line of credit. A line of credit is different to a loan. A line of credit is money that you can use, and only when you've used your line of credit, only when you've spent the money which the bank has provisionally loaned you, does it actually become a loan. So in order to jump from balance sheet 1 to the final balance sheet, we've issued a line of credit here to the fishing person. The fishing person uses that loan, and that then comes in. Let me do it more carefully. The fisherman goes to the fishing tackle shop and uses the line of credit to purchase a fishing boat. The owner of the fishing tackle shop deposits the line of credit, the check, the transfer from the fisherman into the fishing tackle shop. So the deposits on the fishing tackle shop go to 4,000, which means that my total deposits go from 1,000, which is the graduate, plus the 4,000 activated loan from the fisherman, and my deposits of 5,000. And that particular transaction also then activates the change from a line of credit to a loan. A line of credit is not a loan. A line of credit is merely a potential loan. If you have a line of credit, you can use it. If you do not use it, it's not a loan. It only becomes a loan when you use it. So I can issue a line of credit here at balance sheet 1. Unless the line of credit is used, I stay at balance sheet 1. It's only when the line of credit is used that I go to the final balance sheet. Now, the point of all of this, and the point of stressing this, is that what has the banker done? Well, the banker has actually facilitated the purchase of a boat, of 4,000 euros worth of boat. The banker has facilitated the purchase by giving a line of credit to the fisherman. That loan is then deposited by the fishing tackle shop and becomes potential purchasing power for the fishing tackle shop. So what has the banker done? In order to create this additional 4,000 from the 1,000 to the 5,000, in order to create the additional 4,000 euros worth of buying power, the banker issued a loan of 4,000, which was used. So the banker has actually facilitated the purchase of a boat, and in the process has facilitated the creation of an additional 4,000 euros worth of buying power. How does that make you feel? Now, let's leave that conversation alone and let's go back to the island. So now, the graduate sails away, never to be seen again. And then doesn't, because the graduate knows the damage is going to be inflicted on the bank manager. So the bank manager has to call in loans, and the particular loan that's been called in is the loan of the fishing person. But of course, the fishing person doesn't have that money. So the bank forecloses, the bank takes the fishing person's bait and hat and sells it, and more likely than not does not recover the full 800, recovers less than that, for example 387, which you can please see it's not a calculated number, it's just a number that has been made up. So don't send me an email. As soon as that happens, what can we say about the bank? The bank is bankrupt because the bank's assets are less than its liabilities. But let's continue. Let's not tell anybody. Can we do it quietly? And call in the next loan. And for the next loan, we get back less than was loaned out. And in the process, and if you can cast your mind back to the island, what you've now done is not only do you have bad loans in the bank, but you also have created systemic damage, system-wide damage through the island by having shut down the island fishing industry, by having, as a consequence, you shut down the entire maritime industry. Eventually, the bank goes bankrupt, and this part of the balance sheet here is the entire island pension fund. And the correct expression at this point, oh dear, oh dear. Because in effect, this is what happened in 2009 in the States, and this is what happened in 2010 in Europe. This effectively here is the Italian banking system. This is the Spanish banking system. And this here is all the financial assets in Europe, because that is M3, which has just disappeared, or M10 or M18. What comes out of this is the notion that banks are too big to fail. And they're not simply too big to fail because the bank itself is too big to fail, but they're too big to fail not simply because you bring the banks down, but because of the systemic damage that's created in the real economy as a result of bank failures. There's my systemic damage. I've called in the loan. I put the fishing industry out of business. There's the additional loan being called in, and the ongoing damage then is the fishing industry out of business, the maritime industry out of business, the tourism industry out of business, etc., 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 and eventually all the financial assets in that economy disappear because they're all book entry money. So with that as a backdrop, let's just take a quick look. The purpose of the lectures to this point
the number of objectives. One is to show you how banks create money. One is to show you, when we look at M3 in different countries, why it is that cash in circulation is so small and electronic money or deposits is so big. The third is to show you what happens if we try and make the banking system go backwards and the process of calling in loans. But I think from a broad perspective, one of the important purposes of doing our idyllic island is to recognize that doesn't just happen on some far-flung island, but rather it can also happen in a country. It can also happen in a region where banks are integrated. It can happen in the world. And the example that we used in the lectures was the financial crisis of 2010 and so on. And we used a number of different countries to illustrate what could happen. And that's a long time ago. So there is yet some merit in just assessing what national banking systems look like as we speak. So what we want to do is we want to assess the degree of bank solvency at a national level. The typical way that this is done is to look at the non-performing loans in a country, the non-performing loans, or NPLs, as they would often are abbreviated. They are the most widely accepted way of looking at the degree of solvency of national banking systems. Now, a non-performing loan is not yet a bad debt. A non-performing loan is a loan which is on the balance sheet of the bank, but where the borrower either cannot make the interest payment on the bank and or cannot repay the principal of the loan, of the principal which is due. So not the full amount of the loan, but just the scheduled repayment portion of that loan. As you've had before, there are country differences. So some countries will have it as an interest repayment, some countries will have it as a principal repayment, and there are also different timescales as to when a loan becomes an NPL, but typically it's after 90 days. It doesn't really matter. If we keep the definition loose and we say that a loan becomes an NPL if the debtor can't pay the interest and or if the debtor can't pay the principal, and after about 3 months, that's an NPL. And that's all we need to work with. The difference between what we're going to do now and what was done in the face-to-face lectures is that in the lectures, we only use the most recent data on NPLs because of time constraints. But we've got a bit more time in this narrated lecture. So what I want to do is I actually want to start with the NPL situation in 2015 and then run up to the most recent data which is available. And that just gives you the opportunity to see how the level of NPLs have changed over time in a selection of countries we're going to look at.
What's happening in the world in terms of non-performing loans. And you may remember that non-performing loans is a loan where the debtor can't pay the interest on the debt. And if a debtor can't pay the interest on the debt, you can be fairly sure the debtor can't pay the capital sum of the debt. The trouble with non-performing loans is they remain on the balance sheet of the bank because they're not yet bad debt. In the really boring jargon of economics, and you'll appreciate that economics is a terribly boring subject. In the boring jargon of economics, these are called toxic debt. And if you can visualize a toxic debt, it's a piece of IOU sitting on somebody's desk with yellow and green fumes rising off it. That's a toxic debt. These are toxic debts in the world, but with the focus that we want to do from a European perspective, if you look at Cyprus, Cyprus is the world leader in toxic debt, where nearly half of all the debt on its balance sheets is non-performing, it's toxic. If you look at Greece, Greece is sitting at over 1/3 of all debt which is toxic. But the one that we really want to focus on is Italy, where nearly 20%, 18% or 20%, 1/5 of all of the debt on the Italian banking sector is non-performing, is toxic debt in 2015, which is the latest data. We look at Ireland, which is where we're looking at about 15%, even Portugal and Russia. And from my perspective and in my opinion, anything more than 5 or 6% of non-performing loans is cause for concern. So all of these banks that you're looking at here all across the world give cause for concern. And you'll notice, if I can just flag it, that the Italian banking system is worse than the banking system in Burundi. How does that make you feel?
This diagram follows from the previous diagram of non-performing loans. The only difference, of course, as was said, is that the previous one is 2015. This is now 2017 data, as you can see. And the point is to look across the number of countries that we've got in selection here and just see how the non-performing loans have changed. And I think the first thing, which is fairly obvious, is that the scale of the non-performing loans between 2015 and 2017, there's some change. There's some small decrease in the non-performing loans, which is welcome, but there are still very problematic countries in the world. And those countries, from a banking perspective, and those countries are highlighted in this diagram. So you can see that Greece is still sitting at 45%, 46% NPLs of all of the loans in the Greek banks. That is highly problematic. The next one down, which is probably more important than Greece because of the size of the banking sector, is Italy, which is now at 2017 sitting at over 14% of NPLs. And Portugal, over 13% of NPLs, and those are two very, very large banking sectors, as well as Ireland sitting at just under 12% of NPLs. So those from a European perspective are troubling. I won't take it any further. I think we've said enough on those issues. I think the last ones down here is that Russia has actually crept up since 2015 and is now sitting at NPLs of 10%. India has come onto the scene with NPLs of just under 10%, and I just highlight Pakistan in here at under 9%. Where we now go is we start talking about the controlling of money supply, but under alternative approaches. So I need to preface what we're going to do so that you're sensitized to what is coming, and there's no one-size-fits-all answer in what we're going to do, and different countries do control money supply in different ways, and historically money supply has been controlled in different ways. So be sensitized to what we're going to do. I want to start off just by highlighting the issues that we need to talk about. The first one is fairly straightforward. We need to introduce central banks and what central banks do. We then need to talk about some of the policy instruments that central banks will use. We need to introduce some terminology, and it's best to introduce that terminology now rather than trying to retrofit the terminology later on in a lecture. So let's get all the terminology up front and just get it out as definitions. I know it's boring, but it's easier that way. We then want to look at, and this is from the previous slide, and this is really the important part of it, is the controlling of money supply through two different approaches, so-called direct control, which is the direct control of money supply through quantitative controls, and then the so-called indirect control of money supply, which is where you control the quantity of money indirectly rather than through direct controls. And let me preempt what we're going to do. If you control money supply indirectly, you use interest rates or the price of money to control money supply. So it's a preempt on where we're going. And then the second but last thing is we need to look at toxic debt and zombie banks and our friend the zombie. And then finally, we need to head into the twilight zone, which is beyond zombies, and talk about negative interest rates. So just to introduce central banks, because we don't have central banks in here yet, so let's just bring them in. This is fairly straightforward stuff. There are only 2 points that I need to make in this context with regard to central banks. The first one is that central banks cannot go bankrupt. It's not possible. And the reason that central banks cannot go bankrupt is the liability of central banks is the money which they issue or the money which they create. The asset side of the balance sheet of central banks are the assets or the bonds or the equity that central banks buy from the market or buy from banks. So they buy these assets in and they create money, they print money in order to purchase those assets. So the liabilities are just money, and central banks can print money, and as we know now, money is just paper. So there's really no technical limit on how much central banks can print. Obviously, we know that there are limits on how much can be done, but they're not technical limits in that sense of the word. So the second part of introducing central banks is to outline their purpose, and central banks have 2 purposes for what we're doing. The first one is to ensure the integrity of the banking system, to ensure that banks in a country adhere to the rules, the regulations, the whole regulatory framework of what's required by central banks. Okay, in simple English, it means let's just keep the whole show together, just keep the whole banking system together. It's not part of this course. It sits in administration, it sits in legal issues, so it's really not part of this course. But what is part of the course, which is the second of the purposes of central banks, is to implement monetary policy, and that's the focus of this part of the course. And again, I want to preempt what we're going to do. We're going to have a fairly long discussion about the instruments of monetary policy. What are the tools, what are the things that you use in order to either change the quantity of money or the price of money? And we need to get that sorted out. And once we have that sorted out, we then move on to the second part of the discussion, which is what are the objectives of monetary policy? When you use monetary policy, what are you trying to do? What are you trying to achieve? So these are tools, they're technical, okay, and we'll talk about them first. And then these are objectives, which is what is being attempted to be done. So I now want to talk on the basis of what we've just outlined in the previous slide are the monetary policy instruments. What can central banks use? What are the tools at their disposal? And it's useful to talk about those tools for tools which are used for direct control. So if you want to control the quantity of money directly, what are the tools that you use? The second way of looking at that is if you want to have indirect controls over money rather than direct controls, what are the tools that you use? And then the third set of instruments are really other instruments which don't fall into these 2 categories. They kind of some straddle them, some are slightly different. You'll see them as they appear. So if we go back to direct controls, and if you cast your mind back to the island, and if we put a central bank on the island, what is something that the central bank could do to directly control the money supply on the island? And the first thing it can do, and it's obvious from going back to the island, it can change the reserve requirements. So if it were to decrease the reserve requirements, the bank on the island would need to hold less reserves and would be able to lend out more. If it increased the reserve requirements, obviously it would do the reverse of that. The second thing it can do, and it's a new term that's introduced now into the lectures and into this narrative, is conduct an open market operation. And you can read it there. Okay, an open market operation is where central banks buy or sell government bonds in the secondary long bond market to change liquidity in the economy or the banking sector. Okay, in simple language, this is where central banks will buy bonds or will sell bonds to people or to corporates or to banks in order to change how much money there is in the economy. And there are 2 types of open market operations. There's an open market sale, where a central bank sells bonds into the market and when it sells bonds in, it's obviously taking money out because people are paying for those bonds. So an open market sale will reduce liquidity, it will take money out of the economy. And there are open market purchases where central banks purchase a bond, and obviously they pay with money, or they pay with a deposit into somebody's banking account. If you cast your mind back to the island, we didn't need an MBA graduate to arrive on the island with cash in the bottom of the boat. Exactly the same process could have been brought about by an open market operation. And if there had been a central bank on the island, all the central bank really needed to have done was to have conducted an open market purchase. So let's take our fishing person. If the central bank had conducted an open market purchase and purchased a bond from the fishing person then would have received a deposit into their current account. So we would have seen the deposit increasing in the balance sheet of the bank, just as it occurred with the graduate. And the money creation process that we saw would be exactly the same as a result of the open market purchase as it was with the graduate arriving on the island. So we didn't need more cash to come into a system to have that multiple deposit creation process. So we could have had an open market purchase as well. Those are your two direct controls. If you want to go for an indirect control, so if you want to control the price of money, well, clearly interest rates are the price of money. And I'm going to say it now, and I'll say it again later on, that central banks can either control the quantity of money or they can control the price of money, but they cannot do both. The example that I used in lectures is that if we think about the market for shoes, you can either control the price of shoes or you can control the quantity of shoes, but you can't control both. So you set the price, how many shoes will people buy? You set the quantity, how much will people pay for the shoes? You can't set both of them. The same is true of money. You can either set the quantity of money or you can set the price. It's not possible to set both. Obviously, changing interest rates affects the economy, and the transmission mechanism, to use the technical term, or the way that interest rates affect the economy is through borrowing. So if you were to reduce interest rates, there'd be most likely an increase in the amount that people borrow. That's an increase in loans. Those loans would then come through as an increase in deposits, which will become an increase in money supply. Similarly, if interest rates were to be increased, then less loans would be taken or loans would be repaid. And of course, the consequence would be there'd be less deposits and there'd be less money supply. So that's the linkage that we have between interest rates and the economy. This only works if central banks can control interest rates. That's an important point, and we'll hold it over for later in this narrated lecture. Other instruments which don't fall purely into either of these categories are what is called moral persuasion, and this is where central banks attempt to persuade banks by putting pressure on banks to do certain things. So a central bank will try and persuade a commercial bank to lend out more or not lend out more. A central bank will try and persuade a commercial bank to lend to a particular sector, steel, shipbuilding, or not to lend to that sector. The question which was asked in the face-to-face lectures, and I'll pose it again, does it work? Well, it depends on the country. In certain countries it does work, where there's much more control by a central bank over the commercial banks. In some countries it doesn't work. So it really is a country issue as to whether it works or not. The second of these other instruments are called open mouth operations, and this is where central bankers talk about what they're going to do. In today's world, it's called forward guidance, and this is where a central banker, a very good example of that is the governor of the Bank of England, who consistently talks about what the bank is thinking, what the sort of changes are in the market, and what could happen with interest rates. The important thing from a central banking perspective is that central bankers do not want to have interest rates as a murder mystery. So they don't want the market to be taken by surprise. Rather, they want the market to understand the thinking and the processes and where the central bank sits in the consideration of interest rates and the outlook for interest rates. The final instrument that we have here, which is a twilight zone kind of instrument, if you like, is quantitative easing. We know what that is. This is where central banks buy government bonds or buy other kinds of financial instruments out of the market in order to put money directly into the market. I try to introduce some terminology to you so that we've got the terminology up front and we don't have to deal with it later on. There are two important pieces of terminology. The first one is the bank rate, and the second one is the discount rate. And the difference is really important, and there's considerable confusion about the differences between these two rates. And the most authoritative place to have a look at for these definitional differences is the Bank of England. You'll find that there are a number of other sources on the web, and a lot of those definitions being used there are simply incorrect. So this is the correct one. Use it. Do not trust what you see out there. Trust the Bank of England. The bank rate. The bank rate, read it. It's the interest rate which is paid by a central bank when commercial banks make deposits in the central bank. It's very rare. It doesn't happen often. It used to happen. Okay? So it is an interest rate which is paid by the central bank. There are definitional differences. In most countries, the bank rate is where there is a direct deposit. So a commercial bank makes a direct deposit into a central bank. The central bank pays the bank rate. There are a number of countries, and the largest of them, India, China, Saudi, and Kuwait, where there's a system called a reverse repo system. It's the same, it's just a terminological difference, and that is where the central bank actually purchases securities, bonds, from commercial banks and agrees to repurchase these bonds from the commercial banks when they mature. But it's really just a definitional difference here. Okay. That's your definition, be it bank rate or reverse repo. It's what the central bank pays commercial banks. The other extreme of this, the other way that this works, is that you have discount rates or repo rates. Again, they mean the same thing by and large. And a discount or repo rate is an interest rate which is paid by a commercial bank when it borrows from the central bank. That is an important difference. So bank rate, central banks pay the bank rate to commercial banks. Discount rates, commercial banks pay the discount rate to central banks. Okay. It's called a discount rate because often what happens in some countries is that commercial banks will discount a bond. In other words, they might have a bond, for example, worth 100 euros, and the central bank will give them 90 euros for that bond. So they're selling the bond to the central bank at a discount to its face value. That's the interest rate that's being charged. The discount is the interest rate. Again, in some countries, they have what's called a repo system. It's the same by and large for our purposes. The only difference is that the commercial bank, when it sells or lodges the bond with the central bank and gets a discount on the face value, that the commercial bank agrees to repurchase that bond. Okay, repurchase, that hence the word repo, to repurchase the bond when it matures, still with the face value discount. So we now are going to go into looking at direct money supply control. And you'll recall from 2 or 3 slides earlier on, there was a very important distinction made between direct money supply control and indirect money supply control. We're going to start with direct money supply control. We're going to work our way through that only, and once we've completed that, we'll come to the indirect money supply control.
I now want to take what we've done in terms of pictures on islands and balance sheets and turn it into economics and turn it into a demand and supply framework in economics. So what we have now is that the price of money is the interest rate. On the horizontal axis, obviously we have the quantity of money. It's again, it's a quantity axis. There's a demand curve for money, which is a demand curve like any other demand curve. The only issue we need to grapple with at the moment is the shape of the money supply curve. And the way to visualize the money supply curve is we start off at the final balance sheet of the bank, where the bank is fully loaned up at a total amount of euros of 5,000. And then to ask the question, can this 5,000 euros change if interest rates were to change? And the answer clearly is no, because you've got a reserve requirement of 20%. We have a deposit of 1,000. The shape of the money supply curve there is entirely inelastic with respect to interest rates. And as a result, what one has then is a vertical money supply curve. The way you understand the vertical money supply curve is when the bank is fully loaned up at 5,000 euros. Can the bank create more money at 5,000 euros if interest rates change? And the answer clearly is not, because interest rates are irrelevant in the creation of money in this kind of system. So when the graduate arrives on the island, we could, for example, have a situation where interest rates were I1. This is the 1,000 euros that arrives on the island QM2. So that's a quantity of money as the graduate arrives on the island. And what the banker wants to do is to move from QM2, which is the 1,000, to become fully loaned up. Clearly, the reason the banker wants to become fully loaned up is because that there is revenue to be made, because the more loans the banker issues, the more interest the banker can receive. So there's commercial sense to become fully loaned up. Interest rates are too high here because people do not want to take loans at those higher interest rates. So the only way that I can persuade people to take more loans is to reduce interest rates. So the commercial bank reduces interest rates from I1 to I2. The consequence is that as the cost of loans decreases, so more people take loans, those loans come through as expenditure, as deposits, and as that process continues, so the money supply moves from the 1,000 we had as the graduate arrived on the island, and as we issue more and more loans and the loans are used, the bank becomes fully loaned up at a level of 5,000 at the point B. One of the things that comes out of this diagram is the issue about which institution reduced interest rates. Now, you know as well as I do that in today's world, it's central banks that control interest rates. But in this particular world, it was the commercial bank. Because if you don't believe me, go back to the island and have a careful look. And what you'll notice is there's no central bank. And that was deliberate. Because now, what I want to do...
This diagram shows what things would have looked like on the island if there'd been a central bank. And in many ways, it's very similar to the MBA graduate arriving on the island. The only difference is that here, instead of a direct deposit coming in, we're going to do something which will directly control money supply, like a change in the reserve requirements. So the banking sector starts at point A with interest rates I1 and a certain amount of money supply QM1, and it's been driven by the amount of reserve requirements. The central bank then wishes to increase money supply, and it reduces reserve requirements, which increases potential money supply to QM2 and obviously along MS2. But unless the commercial bank reduces interest rates, there's no incentive for people to take loans, and therefore those loans to come back as deposits, which means that the commercial bank, because it's profit driven, will reduce interest rates because it will make additional revenue from the additional loans. So it will reduce interest rates. People will take more loans, which will come back as deposits. We will end up at point B. So what this is illustrating is that it's illustrating the change in monetary policy, in this case a change in money supply driven by a drop in reserve requirements and leading to an increase in money supply. The alternative monetary policy instrument that could have been used would have been an open market purchase, where the central bank had purchased bonds from the market and paid for those bonds with a direct credit into somebody's account, which would have brought about exactly the same effect.
So let's start off then by looking at a bank rate system. This is fairly straightforward. In today's world, there are three players. There are people, there are commercial banks, and there are central banks. And in this particular case, the central bank is the Bank of England, and this actually is the Bank of England. Now, the way that it works, and this is very much from the island, the way that it works is that people make deposits into the central bank, and you'll see that people suddenly get a smiley face, and the bank in turn makes loans. That's what we saw on the island, and you'll notice also that nothing's happening here between the commercial bank and the central bank, because everything is happening between smiley face and the commercial bank. But if you do have a situation where your deposits exceed your loans, and that could occur, for example, if the commercial banks do not trust smiley face, so they don't trust their customers, so they prefer not to actually not make those loans, there is the facility under certain circumstances to actually deposit that difference between the deposit and the loan with the central bank. So if you have a situation where you don't want, where a commercial bank does not want to make the loans, it does have the facility to deposit those funds with the central bank. The central bank then pays an interest rate on those deposits to the commercial bank, and that interest rate is the bank rate. So that's how a bank rate system works. Now, the terminology that we want to use is that we've got three interest rates. Interest rates on deposits paid by the commercial bank to smiley face, interest rates on deposits made by commercial banks to the Bank of England, which is the bank rate, and interest rates which commercial banks charge other kinds of smiley faces for the loans which they're issuing. The system can only work if that interest rate spread lies within this range where the laser pointer is. Let's do an example. Let's imagine that interest rates on deposits are 5% and interest rates, or the bank rate is 3%. Clearly, if a commercial bank is paying out 5% and only receiving 3% from the Bank of England, it wouldn't put money on deposit with the bank rate. It would sooner lend that money out. Similarly, if interest rates on, if the bank rate were, for example, 15%, and interest rates on loans were 10%, well then the motivation for the commercial bank is to take all of the deposits that are coming through here and deposit them with the Bank of England. So for this system to work, it requires that spread of interest rates. The bank rate becomes irrelevant if banks are fully loaned up. Let's do it again. If interest rates are 5% here, 10% here, and 15% here, I'm following the laser pointer, then the motivation for the bank clearly is to pay 5% on its deposits and take all of the deposits and loan them out to smiley face, because it can put money, the commercial bank can put money with the Bank of England at 10%, or it can loan it out at 15%. The motivation would be to loan it all out at 15%, become fully loaned up, and not have any deposits with the Bank of England. If that were the case, there's no deposits here, the bank rate is an irrelevant concept. All of this disappears, this doesn't occur, and of course we're back on the island. So the system that we're looking at in this particular slide is effectively the system that operates on the island. So what we want to do now is just to understand a little bit more detail around what we saw in the previous slide. And we want to understand what's called the spread of interest rates. So we don't have a single deposit rate. We don't have a single loan rate. We have a whole spread of different kinds of interest rates. So the most expensive way that you can borrow money is on a credit card. That's the most expensive way of borrowing money. It's the first part of the spread. This is followed by overdraft rates. It's followed by mortgage rates. Below that would lie the bank rate. And below the bank rate would lie all of your deposit rates. So we would have fixed deposits and we'd have savings accounts, etc. And what we have around that is the spread. So we have a spread from credit cards all the way through to savings accounts. The cause of the spread is risk, and to a lesser extent, bank charges. So if risk were to increase, if the people who borrow on credit cards become increasingly more risky, if we go into recession, for example, what you'll find is that the spread will open up because risk is increased. If we have good times and we have a boom and there's lots of creditworthy customers, the spread would narrow and you'd have a much narrower spread. But you still have the spread. And one of the reasons you have the spread, of course, is because you are taking deposits in, you're paying interest. Commercial banks are taking deposits in, paying an interest rate on those deposits, and then they're round tripping it as interest rates on loans. So your loan interest rate has to be above your deposit interest rates, otherwise you go bankrupt. To repeat what we said from the previous slide, is the bank rate's only effective if it's set between the interest rates that commercial banks charge on loans and the interest rates that commercial banks are paying when they get deposits, for the same logic as we had in the previous slide. If you had a situation where the bank rate were to drop below savings rates, it now becomes irrelevant. And again, for the same reason, for the reason we had in the previous slide. Because if I'm now getting funding from Smiley Face as a deposit, and I'm paying, for example, 5% to Smiley Face, I'm not going to take that money and deposit it at 2% with the Bank of England. I'd much sooner lend that money out. So once the bank rate falls below your deposit rates, it becomes irrelevant, and we're back on the island.
At the moment, we've dealt with direct money supply control, looking at the instruments of how you do it, at how you change reserve requirements, at how we didn't do it, but you can imagine how you use open market operations. The direct money supply control is very much what was happening on the island when the Graduate sailed away. So there's a single major problem with direct money supply control, and that is, how do you reduce money supply without calling in loans? That is the single biggest problem. And if you think about it back to the island and the Graduate, when the Graduate was about to sail away, what did the bank manager have to do? Had to call in loans. Now, if you have a situation where using direct money supply controls and you want to reduce money supply, and you can do this gradually. So a central bank wants to reduce money supply, and it's a gradual process over a number of years. That's okay. You know, you can change the reserve requirement gradually. You can bring back the money supply gradually. You can reduce deposits gradually. But in reality, you often don't have the luxury of being able to do things from a monetary perspective gradually. You have to do them rapidly. And when you do it rapidly, you have to call in loans. Let me illustrate. So we're sitting in a situation with a particular money supply, MS1, as you can see, particular interest rate, and we're at point A. And for some reason, the central bank decides that it needs to reduce money supply. So it may, for example, increase the reserve requirements, or it may conduct an open market sale, and either of those would work. Reserve requirements means that banks have to hold more cash in vault. An open market sale means that the central bank is removing cash out the market. however you want to do that, the consequence is that diagrammatically the money supply curve moves from MS1 to MS2. Inside of the bank, it means that the bank no longer, the commercial bank no longer has the reserves that it needs against its deposits. So the commercial bank is sitting at point A with that amount of deposits in the bank, yet it can only hold QM2 deposits and therefore QM2 money supply against the reserves that it has. So in order to move from point A to point B, it looks very straightforward in the diagram. You simply call in loans and reduce it, and we all go to QM2, and everything is really cool, and we end up at point B, and interest rates are slightly higher. But the problem is in the real world that once you start doing that, if you have to do it rapidly, there's one single problem. You call in loans from people who can't repay the loans, you foreclose on them, think fishing person, island, you foreclose on the fishing person, you continue to call in loans. It becomes a banking crisis because the bank goes bankrupt, at least technically bankrupt, there's NPLs. The financial crisis becomes a real crisis, and etc., 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 and you end up with non-performing loans like we saw in Europe a little while back. So while it looks cool in practice, it's problematic. It was as a result of the problems that we've just seen with direct money supply control, and when central banks wish to reduce money supply control, reduce money supply, they effectively force commercial banks to call in loans with all the collateral damage that that implies. It was for that reason that many countries in the world today operate not using direct money supply controls, but rather using interest rates as a means of an indirect money supply control. And that is where we're going in our conversation.
So now we move to today's world, where the bank rate is really only of relevance in the island type banking systems and in certain instances during the course of the financial crisis. In today's world, at least up till 2007, what central banks tried to do was they tried to create a system by which they could control money supply without calling in loans. And that's where the discount system, the discount rate system, becomes important. So before we get into the details of it, let me repeat. The reason that we have a discount rate system is it allows central banks to reduce money supply without calling in loans. It allows central banks to transmit their interest rate to Smiley Face without calling in Smiley Face's loans. The way it works is that we still have deposits going from Smiley Face into commercial banks, and we still have commercial banks making loans. So that's the same system. And to understand how this process works, commercial banks are fully loaned up. So we're back on the island. We've had deposits coming in, loans going out, and the commercial bank on the island is fully loaned up. Here's the difference. Smiley Face wants a loan. So Smiley Face will deposit some kind of security with the commercial bank. It can be the title deeds to your apartment or your house. It can be access to your goods and services at some form of security. And for that security, the commercial bank gives Smiley Face an additional loan. It's a line of credit. Now, before Smiley Face begins to draw on that loan, the commercial bank in turn has to ensure it has sufficient funds to cover the loan before it's used. So what the commercial bank will do is go to the central bank, in this case the Bank of England. It will give the Bank of England securities, and for those securities the Bank of England will give it a loan. And this is where the system is now very different to the system we had on the island. Because on the island we had a barrier between commercial banks and central banks, and it was very difficult for commercial banks to actually approach central banks in any way. Today, central banks, in order to be able to control interest rates, have engineered the system that you're seeing in the slide. And they actively encourage banks to borrow from central banks. And the place that central banks are borrowing from is called the accommodation window. That's the generic term for where they're borrowing from. So this is a system, this is not an exceptional case. This is a system where the central banks are specifically engineering that this does occur. For more of that later. The system that we have here on the screen, clearly it's not free, and there are interest rates being charged. And the interest rate that's being charged from the central bank, from the Bank of England to the commercial bank, is called the discount rate. And that is the interest rate that the Bank of England charges the commercial banks when the commercial banks borrow from the Bank of England. It's a discount rate. And what the commercial banks are doing is they're taking the money they borrowed from the Bank of England and loaning it out to you and me, smiley face, at the discount rate plus a markup. So suddenly, this system is actually very easy to understand, because the central banks, the Bank of England, is effectively working as the wholesaler. They're selling money at the wholesale rate, which is the discount rate, to the retailer. The retailer is then marking up the wholesale rate and lending the money out to you and me at the wholesale rate plus a markup, which of course is the retail rate. So it's a system which is very easy to understand. This system can only occur when banks are fully loaned up. If the banks are not fully loaned up, then there's no reason for commercial banks to go to the Bank of England. So it only occurs when banks are fully loaned up. But what the system allows, it allows the Bank of England to transmit its interest rate, which is the discount rate, through the commercial banking sector directly to you and me, to smiley face. That's the importance of the system. The system allows the Bank of England to transmit its interest rate through to the commercial bank, in brackets as the wholesaler, to the retailer, and then the retailer in turn continues that transmission to you and me at the wholesale rate plus a markup. The next diagram should illustrate that more carefully. So let's start off again now with the spread of interest rates. We've got the same spread. The only difference is we have the discount rate now sitting in the middle instead of the bank rate. And we still have risk. And the discount rate now governs the position of the spread. So think about it. As a commercial bank manager, you can borrow money from the Bank of England at the discount rate. You're not going to pay smiley face more for the deposits that smiley face is making in your bank than you can pay the Bank of England. In fact, you'll pay less, because the cost of borrowing from the Bank of England, the administrative cost of, so the cost of actually making the loan rather than the discount rate, the administrative cost of borrowing from the Bank of England is way less than the administrative cost of taking fixed deposits or savings. So the discount rate immediately caps all deposit rates. In turn, the commercial bank is borrowing from the Bank of England at the discount rate and lending out that money to smiley face. Clearly, the commercial bank is not going to loan out that money at less than the discount rate. If it did that, it would very soon go bankrupt. So the consequence is that the discount rate governs the position of the spread, because commercial banks are borrowing at the discount rate and lending out at more than the discount rate, and they can take money, they can borrow money from people as fixed deposits or savings accounts, or they can borrow from the Bank of England. They're not going to pay their depositors more than they can pay the Bank of England. The discount rate governs the spread. So if the discount rate were to fall, the entire spread moves down. The discount rate governs the position of the spread. So now, if we now try and visualize this again, in the context of a price quantity axis, what is the central bank doing with the discount rate system? Well, what they're doing is they're setting the interest rate. They're setting the discount rate. And what you can do is you can borrow as much money as you want to at the discount rate, which means that it's the price of money which is being set, and the amount of money which is being borrowed is determined by money demand. So what we have then is we have the independent variable in the system is the interest rate, and the dependent variable is money supply. Central banks set the interest rate. People choose how much to borrow based on their money demand at a particular price, and that results in more loans, more deposits, and a particular amount of money supply. The monetary policy instrument that is then used in a discount rate system is, of course, the discount rate itself. So if central banks choose to reduce money supply, if central banks wish to increase money supply, they would reduce interest rates from I1 to I2. We would take more loans. People, smiley face, would take more loans. They'd come back as an increase in deposit. And as a result, money supply would increase. So the instrument of monetary policy in this kind of monetary regime is interest rates, the price of money. It helps now to compare the two different kinds of regimes. The first regime is we have interest rates set by commercial banks. This is the island. So in the island, what central banks are doing is they set the reserve requirement, they set the quantity of money, and the monetary policy instrument is a change in reserve requirements. So a central bank would increase reserve requirements in an attempt to reduce money supply from MS1 to MS2. The consequence is that we would move from point A to point B, and interest rates would increase from I1 to I2. But of course, and I'm repeating, but let's emphasize it, that can only be done, the movement from point A to point B can only be done if the commercial bank calls in loans. And clearly, that results in real systemic damage through the economy, and it's problematic. And it's for this reason that we change the operating system from direct controls where interest rates are set by commercial banks to where interest rates are set by central banks. So central banks now set interest rates. We have a horizontal money supply curve. If the central bank wishes to reduce money supply, it increases the discount rate from I1 to I2. And when that occurs, the first thing that happens is we start off at point A at an interest rate of I1 with a certain money supply. And the moment that interest rates are increased, we simply move to point C, because you have a certain amount of loans, interest rates are increased as we're having this conversation, you haven't paid off your loans, which means you had a certain amount of loans at point A at an interest rate I1. You've still got exactly the same amount of loans, which is at point C, simply at a higher interest rate. How do you respond? Well, you respond by reducing your loans. So gradually over time, you pay off your loans, which means your money demand changes. As the money demand changes, of course, money supply changes. And the consequence is that you have been able to achieve a reduction in money supply without calling in loans. And that is the thing that's important in this story. So what we've got in this particular slide, it is effectively a summary of the island and the discount rate. So this is a bank rate, this is a discount rate system. This system worked perfectly well, and this system here is a system which evolved over time from Samuel Goldsmith and the evolution of the banking system. It worked perfectly well until we wanted to reduce money supply. And the only way you can do that is to increase reserve requirements and to call in loans. That has systemic damages. So what one then wants to move towards is a system where you can decrease money supply without calling in loans. You do it by increasing the cost, by increasing the discount rate, which increases the cost of loans, so people pay off their loans. We therefore reduce money supply. You will appreciate, of course, that there will still be firms that go bankrupt. If you're highly leveraged at point A, you can't bear the higher interest costs at point C, you do go bankrupt. So there will still be damages, but the damage is not nearly as great as calling in your loan. All that a central bank is doing is making your loan more expensive and you attempt to pay it off. It's not saying, give us back the money. It's simply saying it's more expensive. One of the things that we stressed a moment ago is that in order for the discount rate system to work, you have to have the banks fully loaned up. Let's explore what happens if banks are not fully loaned up and how a central bank, in this case the central bank of the Bank of England, has to respond if banks are not fully loaned up. Let's take something which actually happened. We had an inflow of capital from India when India purchased a large part of the British motor vehicle industry, Land Rover and Jaguar. So we have an inflow of capital from India through to the purchase of the motor industry. And that money, which is a capital inflow, went to the owners, the shareholders, and came through as a deposit into the accounts of the shareholders. So we have a movement of capital from India through the purchase of Land Rover. It's called a capital inflow. That's the technical term in economics. It's a very large purchase. It went to the shareholders. It went into their accounts. And the first thing that a bank manager, the question here is, what would the bank manager of a commercial bank do? Because the bank manager's got one of two choices. The bank manager can attempt to issue more loans because it's got more deposits, or the bank manager can repay the accommodation that it has from the Bank of England. One of the challenges with attempting to issue new loans while you still have loans with the Bank of England is that your wholesale rate remains the discount rate. And if you want to issue more loans to Smiley Face, you have to reduce your markup. Your markup compensates you for risk. So if you reduce your markup, you are taking on more risk. It's very unlikely that bank managers will voluntarily take on more risk. So it's very likely that when we get these increased deposits coming in here from the capital inflows, that the first thing that bank managers will do is to pay off their accommodation. And now we have a situation, and this is a very large capital inflow, and it is sufficient and was sufficient to entirely negate all of this accommodation. So now we have zero accommodation. What do bank managers now do? Well, they drop interest rates because there's no longer a wholesale rate. Commercial banks now control interest rates. They drop interest rates and they make the loans. But you'll appreciate that as soon as that happens, this entire system on this side, on the right-hand side where the laser pointer is, that disappears. And the Bank of England now no longer has any control over interest rates. The Bank of England has no way of transmitting its interest rates to commercial banks, which means we're back in the old banking system. We're back on the island. And the only way that the Bank of England can control money supply is through reserve requirements and all of the potential damages that a reserve requirement system has. So the Bank of England can't allow this to happen. So what the Bank of England has to do is to absorb this liquidity. Okay. And you'll recognize the terminology I'm using. if it's going to absorb that liquidity, it has to conduct an open market operation. So what the Bank of England will do, it will sell bonds to the market. So now we have a flow of the Bank of England selling bonds into the market, to the bond market, let's get to smiley face, and in the process reduces the liquidity. So what we have here, that's an open market sale. It's bonds from the Bank of England going into the bond market and reducing the liquidity of the market. And once you reduce the liquidity of the market, of course, the Bank of England has absorbed this increase in deposit. The Bank of England has absorbed this capital inflow and in the process ensures that the commercial banks are fully loaned up, and ensures that when people need additional loans, that it forces the commercial banks to borrow from the Bank of England. It forces the discount rate through the commercial banks to smiley face.
There are two parts left to understand and complete the instruments of monetary policy before we move on to the objectives of monetary policy. And that is to look at quantitative easing within the context now of the diagrams that we've drawn, and to give a bit more detail about QE, and then finally look at negative interest rates.
This now brings us to post-2007, which is quantitative easing. And the way quantitative easing works in 2007 is unique in the history of banking, because what you have post-2007 is that banks are not fully loaned up, commercial banks are not fully loaned up, they are holding excess reserves, and they're also holding toxic debt. The toxic debt clogs up their balance sheets. Because you've got non-performing loans in your balance sheet, you can't use those loans as they mature to issue loans to people. You also hold excess reserves against the probability that your non-performing loans will become bad debt, and you have to write them off the balance sheet. So the toxic debt results in effectively a clogging up, a seizure of what's happening in the banking sector. And the loans that we need to go to corporates are not occurring, and the system seizes up. That's where central banks introduced the idea of quantitative easing. So what the Bank of England did do is they bought long-term bonds from the banking sector. In effect, what the Bank of England did was it actually purchased this toxic debt. So it actually purchased the toxic debt off the commercial banks and holds the toxic debt in the Bank of England. It also, to a lesser extent, purchased bonds directly from corporations in the UK, Ford Motor Company, for example, and it put money into the banks. So that's the corresponding entry. So I've bought the bonds off the banks, and this Bank of England is putting money into the commercial banks, and it's also putting money directly into corporates. One of the reasons for this latter component of the QE is the earlier versions of QE was simply the movement from commercial banks to central bank. That was the movement. But what was happening is that even though the Bank of England was absorbing this toxic debt and reducing, hopefully, the reserve requirements, the excess reserves that were being held by commercial banks still were not willing to lend out to corporate UK because of the concerns about the solvency of corporate UK. So even though the Bank of England was achieving its objective of reducing toxic debt in the banks, the money was not going to smiley face, which is where the Bank of England then reintroduced this additional component of QE, where it became actively involved in working directly with UK corporates rather than indirectly to the commercial banking sector. The purpose, just to summarize it, the purpose of QE was to provide funds to the real economy where banks would not provide those funds on the one hand, and to help remove the toxic debt from the banks. Okay, so that was the objective. One of the things that is required in order for this to occur is that the bank rate has to be negative. Try it. Let's see what happens. So the Bank of England buys bonds from a commercial bank and recapitalizes the commercial bank. Effectively for nothing. Let's just keep it at the cost of this QE transaction for the commercial bank is zero. The intent is to lend it out to corporate UK. But as a commercial banker, if you don't trust corporate UK, you wouldn't make the loans. What would you do with your excess reserves? Deposit them with the Bank of England and get a positive bank rate back. Clearly, the Bank of England can't allow that to happen, because what the Bank of England is doing, or what the Bank of England would be doing, is they would be supplying funds to banks at a zero cost. Commercial banks would then deposit those funds in the Bank of England, and the Bank of England would pay for the deposits. Okay. That is not what you want to have happening. So the only way you can prevent this QE coming through as a deposit into the Bank of England is to charge a negative bank rate. So if commercial banks wish to deposit QE with the Bank of England, they have to pay for those deposits. We need this in a moment to understand negative interest rates. This is where negative interest rates actually come from. This is the intent of QE. The intent was to recapitalize the banks and for the banks to lend out to corporate UK. Up till the end of 2016 and the beginning of 2017, this was not happening. QE certainly was happening and going to commercial banks, but it wasn't coming out from commercial banks to corporate UK. Where was the money going? Well, there's no clear evidence on the matter, and if you please read the fine print, it says that Barry can't find data on this issue. But what I am doing, and this is in my opinion, if I look at what's going on in the world around us and I look at the price of equity, the price of real estate, what's happening in emerging markets, I draw the conclusion that this QE, which is coming from the Bank of England and the ECB and the Federal Reserve, etc., going to commercial banks, is in fact going through other kinds of financial institutions like hedge funds and coming out into equity, into real estate, into emerging markets, and so on. The consequences? I'll let you draw your own conclusions. How does that make you feel?
The final issue we have to deal with in the instruments of monetary policy is to enter the twilight zone and to look at negative interest rates. Now, there is quite a lot of confusion around negative interest rates. And what was pointed out a few minutes ago was that negative interest rates are critical if QE is going to work. And the interest rate, which is the relevant negative interest rate, is the bank rate. Because if you have a positive bank rate and there's quantitative easing, commercial banks have an incentive simply to take the funds which have come from the central bank and with a positive bank rate simply deposit them back with the central bank. So it's that issue where we actually have negative interest rates, at least in the Eurozone. So this is what this diagram illustrates. And what we have in the diagram is we have the EU deposit facility rate, which in the terminology that we've been using is the bank rate. It's read off on the left-hand vertical axis and is shown as the blue line in the diagram. And you can see quite clearly, looking where zero is on the bank rate, that the bank rate is negative and is negative right throughout this diagram. And that holds with what we've seen in terms of making QE effective. The second interest rate that we have in the diagram is the discount rate, or the ECB interest rate, but what we call the discount rate. It's read off on the right-hand vertical axis, and it is obviously the dotted line that we've got in this diagram. And if you look at the dotted line and you see where 0 is in the dotted line, you can see that the discount rate is 0. It's certainly not negative. So the whole debate around negative interest rates and that they're going to be terrible for people and all the rest of it is actually a misguided debate within the Eurozone context, because it's only the bank rate which is negative. Discount rates are in fact not negative. However,
a large part of the previous conversation has been about understanding the institutions of money and the institutions of banking. One of the underlying objectives that we have in this part of the course, and one of the things that I'd like you to take away from this part of the course, is how to forecast interest rates. This is where we start moving on to in the conversation. So we need to now start looking no longer at the instruments of monetary policy, but rather at the objectives of monetary policy. So when a central bank sets interest rates, the conversation now is no longer about how it sets interest rates, but rather why it sets interest rates, what it's trying to achieve. And the generic objectives of monetary policy are: the first one, the most obvious one, is to control inflation, and in the course of the financial crisis to control deflation. Many countries before the financial crisis actually had inflationary targets. For instance, the UK had an inflation target of 2%. And up till the financial crisis, the key focus of central banks was really on their inflation target. They didn't really give much credence to any of the other potential objectives of monetary policy. But it became very clear in the financial crisis that even though there was an inflation target and central banks professed that the key objective of monetary policy was inflation, it was very obvious that once the economies were under threat, the inflationary target actually was entirely irrelevant, and all that was really relevant was saving the economy. So the general view one would have of the objectives of monetary policy, certainly pre the financial crisis, was purely inflation targeting. It has been shown over the course of the financial crisis that this actually pragmatically is not the case. Those are your two key objectives of monetary policy. It's inflation and the state of the economy, and those are your trade-offs in terms of your inflation targets. But there are a number of other factors that central banks must take into account when looking at these two key objectives. And the third one is money supply. And we come back now to, if you like, Economics 101, which in the course of this part of the course has become Economics 201, but that really doesn't matter here because all we're talking about is money supply. And you'll notice that what we've got here is, in brackets here, is credit extension. So one would look at credit extension, which will become loans, which will become deposits, which will become money supply. So one does need to follow that process. The reason, of course, that we have money supply as a secondary objective, of course, back to Economics 101 or 201, if there's an increase in money for a given state of the economy when we're at capacity, obviously, that increase in money will come through as an increase in inflation. So your increase in money supply is a variable which central banks will watch, because any unexpected increase in money supply when the economy is at capacity will come through as an increase in inflation. The next of the variables that central banks watch is the exchange rate. And in certain countries, in fact, like Singapore, for example, the exchange rate is in fact the objective of monetary policy. So whereas in most countries we have inflation targeting as the objective of monetary policy, in certain specific countries, Saudi Arabia, but Singapore is the most obvious example, it's actually exchange rates which are the objective of monetary policy. But in a European context, it's important to understand that exchange rates are a double-edged sword where it comes to the key objectives of monetary policy. So if we take exchange rates, and let's put ourselves in the UK, if the pound were to depreciate as it did post-Brexit, then the consequence of a pound depreciation is that imports into the UK cost more. Because imports in the UK cost more, we have inflationary pressures in the UK. So one needs to see a currency depreciation here as resulting in inflation, and in fact that did. But the other side of the double-edged sword, of course, is that a currency depreciation can, at least in the short term, bring about an improved competitiveness of exports. So for example, the pound depreciates as it did post-Brexit, which means that the cost of visiting UK as a tourist would reduce because accommodation prices are down in euro terms, restaurant meals are down in euro terms, which makes the British tourism industry more competitive, and of course attracts more tourists and boosts the economy. So one needs, and of course if you get a currency appreciation, it works in the reverse, and I'll leave you to work your way through that one. But therefore realize that the exchange rate is a double-edged sword because a currency depreciation can cause inflation on the one hand and can boost the economy on the other. So central banks clearly need to be watching the exchange rate because it has the effect of influencing both of these key objectives of monetary policy. The final objective of monetary policy, the final thing that central banks have to watch, is they have to watch what's happening with world interest rates. Because it's not just interest rates in a country that are important, it's also interest rates in the rest of the world, because those interest rates influence capital flows. So if you have interest rate differentials between a country and the rest of the world, any changes in world interest rates change the interest rate differentials and therefore bring about capital flows. Let's take an example. Imagine in the UK, interest rates are unchanged and interest rates in the rest of the world go up. The consequence is that there's likely to be a capital outflow from the UK to the rest of the world to take advantage of the higher interest rates in the rest of the world. That would then cause a depreciation of the pound, and the depreciation of the pound then feeds into inflation and the state of the economy in the way we discussed a moment ago. So central banks do need to be watching what's happening with interest rates in the rest of the world, because any changes in world interest rates affects through capital flows the exchange rates, and therefore affects the two key objectives. There's a missing link, and the missing link is real interest rates. In the next slides that follow, these slides, I'll come back to real interest in a moment. In some of the slides that follow, they simply add some flesh to these variables here, particularly inflation. So if I just wanted to show you through to some inflation targets. So historically and today, we still have inflation targets, and you can see these different inflation targets that we have here. We have inflation targets here. And you can see the UK, the one that we've been discussing here at the Bank of England, is a 2% inflation target. And you can see these inflation targets of other countries. The rest of these slides really just add some more material to what we discussed. So this is about the state of the economy. I have spoken about it, so you can talk through it. Money supply, okay, I'm not going to talk you through it. You can see what these things are doing here. We've discussed it. Exchange rates, we've discussed it. World interest rates, again, discussed it. The conversation now returns back to real interest rates. Real interest rates are the difference between nominal interest rates and the inflation rate. The notation that we use is we use the lowercase r for real interest rates, lowercase I for nominal rates, and real interest rates are your nominal interest rates minus any inflation rate. That's mechanical stuff. What real interest rates do is they determine the stance of policy. In other words, when real interest rates are high, they're contractionary. When real interest rates are low, they're expansionary. Think about it from you as a saver. Where you save money, what's more important to you? Real rates or nominal rates? Clearly real rates, because you as a saver, and correctly so, you're looking at the difference between the interest rate that you receive from your commercial bank and the gains you get from that, and any losses as a result of inflation. So from a savings point of view, real rates are important. The same is true for borrowing, although it's less obvious and people do not necessarily look at real rates when they're borrowing. But what we'll see in the next slide is that it is important that when you are borrowing, that you also look at real rates. What this slide is showing you, it's showing you the discount rate in the States, which is the Fed fund rate, the blue line, and inflation rates in the States. And from a real rate perspective, if we start at point A, what you've got at point A is you have interest rates equal to the inflation rate, and therefore you have real rates of 0 at point A. At point B, you have interest rates which exceed the inflation rate, and you have real rates which are positive. And at point C, you have inflation which exceeds interest rates, and therefore real rates are negative. So if we do that with some simple numerical examples, at point B, we had a situation where interest rates were 5%, inflation was 2%, and we have real rates of 3%. Alternatively, at point C, you had interest rates of 0, we had inflation of 4%, and therefore you have real rates of -4. Now, let's try and use these numbers to understand the stance of policy. Let's start at point B. If at point B you took 100 euros and you saved 100 euros into the bank, at the end of the year you'd get out 105 euros. Your objective in saving the 100 euros was to buy a pair of shoes. And the pair of shoes at the beginning of the year cost 100 euros. At the end of the year, the shoes cost 102 euros. So you have earned 3 euros by saving the money, because you deposit 100 euros, the shoes cost 100 euros at the beginning of the year. At the end of the year, you get 105 euros out. The shoes cost 102 euros. You have 3 euros for saving. Try the same thing in this example here, but instead of saving, let's borrow. So I borrow 100 euros and I buy the shoes immediately. I don't use the shoes, I keep them in a safe place. At the end of the year, I pay off my 100 euros, which has not accrued any nominal interest rate. I sell the shoes for 104 euros, and as a consequence, I have 4 euros from having borrowed. The cost of borrowing, minus 4. Therefore, let's understand the stance of monetary policy in the context of these numbers. Here, real interest rates encourage savings and make loans expensive. You have to pay for your loan. If it encourages savings, it discourages expenditure. That's contractionary. If it makes loans, the cost of a loan, positive, it costs you to borrow money, which may not be contractionary, but at least it costs you to borrow money. Try the situation here. If you save money at point C, you end up by losing money from your savings. How do you respond? You don't save, you spend. It's expansionary. Similarly, if you take a loan, how much are you paying back of your loan? You're paying less than you borrowed. What does it mean? It means you're being paid to borrow. How do you respond? You borrow. So this situation here is that you don't save and you do borrow, and of course you do spend. So in both cases you're spending. That's expansionary. In this case here, you save, you don't spend, and you don't take as many loans as you would do otherwise. It's contractionary. That is why it's real interest rates that determine the stance of policy and whether it was contractionary or expansionary, both from a savings perspective and a borrowing perspective. This slide summarizes the conversation that we just made. So it's real interest rates which are more important for savings. It's real interest rates which are more important for borrowing. And then here's the question. What happens when there's an unexpected real increase in real interest rates, and how does this impact on borrowing? Hear the question again. You borrowed a certain amount, particularly as a corporate, and suddenly there's a change in real interest rates. How do you as a corporate person feel the change in the real interest rates? Let's look at the next slide.
The purpose of the slide is to show you a number of situations where there were differences between what was being perceived as a change in interest rates, because people were looking at changes in nominal interest rates, and what was actually happening with real interest rates, which is the true stance of monetary policy. If we take the first of these places where the circles just appeared, and if we start off by looking at nominal interest rates, you can see that nominal interest rates are relatively constant within that circle. So the interpretation by looking purely at nominal interest rates is that the stance of monetary policy is in fact neutral. Yet, if you look at real interest rates, you can see that real interest rates were actually increasing over that period. And the reason for it is because you've got constantish kind of nominal interest rates, but at the same time, you have a falling inflation rate. And it's the combination of those two variables that results in these higher real interest rates. Now, in the context of the question which was posed a few minutes ago, how does that manifest itself? Well, for a corporate, so how does a corporate begin to feel the changes in real interest rates, even though we're thinking that nominal rates are unchanged? Well, because the inflation rate is falling and companies put up their prices based on the inflation rate, because the inflation rate is falling, they cannot put up their prices by the degree which they expected to put up their prices. So if anything, the rate of change in their price increases is coming down, while interest rates are remaining constant. And it's the trade-off between interest rates remaining constant at 5% or 5.5% in this case, and the rate of change in prices that you were thinking you could put up your prices by 3%, but you end up only being able to put them up by less than 2%. It's that combination of the two variables which actually means that you can't put your prices up by what you thought, which means that although the nominal cost of your loan is constant, the real cost of the loan is going up because you haven't been able to pass on the loan in terms of higher prices. And it's that trade-off between the perception that nominal rates are constant and in fact real rates are increasing, and that's where, first of all, there's a misconception about what's going on with the stance of policy, and the way it is processed within a company is that your interest rate and your debt remains unchanged, and you cannot pass the price increases onto your customers in the way that you'd hope to pass those price increases on. So your price increases are lower than you expected them to be. Your interest rate is constant, which means that the real cost of borrowing has gone up. The rest of this slide is predominantly repeats of that. So we'll just look at some periods of misconception with that as an explanation. So if one looks here at the next period, here you can see nominal rates are going up, which, if that's all that people are looking at, would be perceived as a tightening of monetary policy. But at the same time, you also have inflation going up. So in fact, what you have is the stance of monetary policy is in fact neutral when you look at real interest rates. This one is a very graphic example of the same thing. I'm looking really in the right-hand part of the bubble. If you look at nominal interest rates, you can see they're dropping. But because inflation was dropping at the same time, and you look at real interest rates, there's actually a very dramatic tightening of real interest rates and a very dramatic tightening in the stance of monetary policy. And then finally, for some considerable time now, there has been an increase in nominal rates in the States, which has been perceived to a limited extent as a tightening of the stance of monetary policy. But because inflation's also been going up, in fact, the stance of monetary policy and real rates have been negative. This is just beginning to change as per the discussion right now as we speak, because what you've got is further increases in nominal interest rates, but inflation has just peaked down below those nominal rates, which means that real rates are just becoming positive, have just been increasing and have just become positive.
The final part of the conversation in this section of the course brings us full circle back to the component that I'm hoping you can take away from this course. How do you forecast interest rates? And what we're going to do here is we're going to use the UK as an example of a way to forecast interest rates. In order to do that, we start off with simply listing the objectives of monetary policy. So that's the list we had from earlier on. And we start with some factual information on this list. So the factual information.
So we now put some flesh to the variables we had to the boxes we have in the previous slide. And the one obviously we start with is real interest rates, which gives us the stance of monetary policy in the UK. We start with the inflation rate and of course interest rates. The inflation rate is being read off on the left-hand vertical axis as the blue line, and you can see that inflation sitting in this period here about 2.5%, almost 3%. It begins to drop later on into 2019, but by January or the first quarter of 2019, you can see we're still sitting around about 2% without worrying about the decimal point. On the other hand, if one looks at the discount rate in the UK, the dotted line, which is being read off here on the right-hand vertical axis, you can see that while it was 0 sometime before this, there have been some increases in that discount rate, but it's still very low. So if one takes the discount rate, even at 1%, if you want to do a decimal point, and an inflation rate of 3%, obviously we still have negative real interest rates. This is the UK inflation rate, first quarter 2019, and you can see how the inflation rate has been dropping. Bear in mind that the UK has an inflation target of 2%. So inflation in the UK goes below the 2% target at the beginning of 2019 and is currently sitting below that inflation target. The UK economy growing at rates which are positive, but certainly not something that one would be proud of. They're all less than 1 percentage point growth rates. And in the first quarter of 2019, you're looking at a growth rate of 0.2 percentage points. It's a low growth rate. The changes in money supply in this particular diagram, I'm showing you a long time period because I need to sensitize you to the fact that when one looks at money supply growth rates, you in fact do want to have some gradual and fairly consistent increases in money supply. You need increases in money supply to fuel the economy, to oil the wheels of the economy, because if you didn't have an increase in money supply, if you think about the quantity theory, as production increases, if money supply does not increase, there's actually going to be a downward pressure on the price level. So as quantity increases, as Q increases, as GDP increases, you do need more money in the system to allow for that increase in production and that there isn't a downward pressure on the price level. So this increase in money supply is desirable, and it's the kind of thing that would happen in a normal economy. And this part of it here is abnormal. So here you have a situation where money supply growth rate is, to by and large, 0. There's been no increase in money supply on average across the period here. And in fact, in periods of actually falling money supply. That is not healthy, because what it says to you is that people were not taking loans, largely because banks wouldn't give them loans, but people were not taking loans, and also because confidence was low. So there were no loans, low levels of deposits, and therefore low levels of increase in money supply. That's a very unhealthy situation. You can see now it begins to normalize here starting 2016. So there are increases in money supply which look a bit more like that, so that's fine. But then just take note of this little tail. It could be noise. It's not quite clear what's going on with that little tail. So if we now jump to money supply with more fine-grained and more recent, which is what we need for the purposes of assessing monetary policy, you can again see that little tail that we saw a moment ago, and that you actually have money supply dropping. If the trend continues, it's not healthy. It's not clear whether this is noise, but if you look over this period, there were these increases in money supply. So all we can do is watch the space. But if I was the governor of the Bank of England, I'd be watching this space very carefully. Finally, we come to the exchange rate of the pound to the dollar. And the way we interpret this exchange rate is that 1 pound buys you a certain amount of dollars. So 1 pound buys you $1.2, 1.3, 1.4, 1.5, and so on. So just to pick it up from here, here's Brexit. In fact, there's the announcement of Brexit. So you can see this huge fall in value of the pound post-Brexit. Then there's some misplaced euphoria in the UK. I don't quite know why. It doesn't matter for these purposes. And the pound appreciates. And then we've seen a fairly long depreciation again of the pound. Blame the British Parliament if you like. And then some small appreciation. Again, it's not clear whether this is a trend change or whether this is noise. But I think the fact remains the pound has been depreciating over this period here with some little appreciation in recent months. World interest rates. There have been changes in world interest rates. The pressure largely is a downward pressure on world rates, and we'll see in a moment where that pressure is. I think the only thing that we want to say excuse me, in this diagram is that UK interest rates kind of sit towards the bottomish part, or the bottom 1/3 part of the spread of interest rates in the world. But they're not too far out of line with similar countries. Okay, the US is a little bit higher, but Eurozone, France, Germany, all the rest of it, they're all in that same kind of space. So we're now in a position to take a view on the outlook for interest rates in the UK. What we have in the table is we have some of the objectives of monetary policy. Obviously, nominal rates is not an objective, it's an instrument. Real rates is the consequence of nominal rates and inflation. They're not objectives. But you have inflation, economy, money supply, exchange rates. Those are your main objectives. Then you have external environment, which is the world, and then we have the overall assessment. So we need to take these 5 factors into account when we assess the outlook for interest rates, but we also need to have an assessment of where we stand in terms of the stance of monetary policy, and the stance of monetary policy is very easy. We have negative real interest rates. So nominal rates are 0.5, we have negative real interest rates. We saw a moment ago that inflation is 1.9%. There's a target of 2%, so inflation is below the target. We have the economy, which is growing, but that's not really anything to be proud of, at 0.2%. We have a fall in money supply. We've had some very small appreciation of the pound since 2018. And the UK sits just below the middle of the group of 20, the so-called G20 countries, with the only exception in there being the US. So we then do something quite simple, and we say, if you were the governor of the Bank of England and you faced each of these 5 factors that you're looking at here, what would you do with interest rates based purely on each individual factor? So we're being relatively simple in the exercise we're doing here, but it's good enough for our purposes to be able to get a view on the outlook for interest rates. So inflation, 1.9%, below target. Interest rates, if you were the governor, would you put them up, bring them down, keep them constant? Well, I think it's fairly straightforward. Inflation is below target and has been falling, so I would drop interest rates because I want to boost the economy and therefore get my inflation back to target. Inflation is too low, you want to get it back to target, you want more spending. The economy is not doing very well at all, so Governor Bank of England, what do you want to do? I want to boost the economy, so I would cut interest rates because I want people to borrow more, I want them to spend more. Money supply is negative, as I said a moment ago. That is highly problematic. It may just be noise, this very small negative period that we're seeing in the last 2 quarters, or it may be the onset of a trend. It's not known. If I were the governor, it would make me nervous. So I would want to tend to reduce interest rates to stimulate loans, to stimulate money supply. The pound has appreciated. Now, a pound appreciation is going to do two things. It's going to make inflation lower because imports will cost less, and it's going to make exports less competitive. So the pound appreciation is going to work against inflation, which you want to have it up, and it's going to work against the state of the economy, which you also want to have up. So the consequence is that the governor probably wants to have the pound to depreciate, but we've already got interest rates dropping because of inflation and because of the economy. So you can really keep this interest rate variable here either constant interest rates, because I've already got 2 drops for those 2 here, or down. So it's difficult to call it. I'm putting it as a flat, unchanged interest rates. It wouldn't take very much to convince me to also have that as a downward sloping arrow. But I already have those 2 in here, and I've got a third one. So I've got a lot of downward pressure on interest rates. And then finally, with world interest rates, they are constant except for the US. And because of US interest rates and because of the carry trade and the potential for funds to move from the UK to the US, if the governor wanted to prevent that kind of carry trade from UK to US, then interest rates would go up. But again, this one is a complicated argument because the governor may actually wish for a depreciation of the currency. And if there was a depreciation, the governor would actually be more than grateful if there were capital outflows from Britain to the US, and may actually want to keep those constant, keep interest rates constant in the context of that variable. So these 2 are somewhat problematic and somewhat challenging. But if we simply take stock of what we have and we simply add up the ups and downs in the arrows, you've got 3 downs, 1 neutral and 1 up. So collectively these give a very simple answer, that the outlook for interest rates in Britain is down. It could also be reinforced if I brought this one down. It could also be reinforced if I brought that one down. There's one final piece to the puzzle which is not part of this table, and in any other country in the world it would never be part of this table. But in the UK it's up in your face, and that's called Brexit. And nobody knows what Brexit is going to bring, whether there's deal, no deal, a May deal, heaven knows what kind of other deal there can be. The Bank of England has to keep its powder dry. It's got to keep its interest rates in a position to be able to maneuver. Brexit, more likely than not, is going to cause an economic slowdown in Britain. It may even cause a pound depreciation in Britain. So you could, the final force for the UK as we speak in this context are lower interest rates for all of these normal variables we take into account in other countries, as well as lower interest rates because of Brexit.
However, to use what we've done a moment ago, where we've drawn our conclusions from first principles, let's look in the crystal ball. And let's understand how the crystal ball will help us confirm or not confirm the conclusion we drew a moment ago. Before getting to the heart of the matter, which is how we use the long bond to forecast future expected money market rates, there is some merit in just looking at the demand and supply curves that lie behind the long bond market. So what we have in this particular diagram is we have interest rates in the long bond market, which are different to discount rates. And on the horizontal axis, we have long-term savings and long-term borrowings, which is investment. Long-term savings are driven by interest rates, unlike short-term savings. So short-term savings, you may be saving in order to buy a car or to buy an apartment. Long-term savings are driven by interest rates. So as interest rates increase, so long-term savings tend to increase. Long-term borrowing, again, are driven by interest rates. So as interest rates decline, so corporates and people tend to borrow more long-term. that results in the market clearing. So this diagram, which is a diagram of the capital markets and how capital markets operate, you'll immediately recognize as being quite different to how money markets operate. Where in money markets we have money supply, we've got supply of money, demand for money. In this one here, we have savings and borrowings, or savings and investments. This is supply of savings. This is a demand for savings or borrowing. So the diagrams are different and need to be used in different ways. Then just from a discussion perspective, the secondary long bond yields are the result of the buying and selling of existing government bonds. They're not the result of buying and selling of new government bonds. So this is the secondary long bond market, not the primary long bond market. The first slide in this part of the course. And this is the important bullet. We use the long bond yields in the secondary long bond market to signal the bond market's expectations of changes in money market rates. This is a key observation. So we're going to use the changes in long bond yields to signal what the market thinks the central bank is going to do with interest rates. It only works if there's an active long bond market. And you do need to use bonds which are more than 5 years from maturity. If you've got a bond which is 1 year from maturity, the value of the bond is affected by the fact that it's so close to maturity. So you need to be using bonds which are well away from maturity. Here's a bond. This is an American bond, as you can see. And the thing that's important on the face of the bond, first of all, there's the number of the bond. And it says the government of the USA promises to pay the bearer the sum of $1,000. And there's the term of the bond. It's between a 2000 and 2007 bond. And there's the interest rate or the yield on the bond. So this is a bond. It's an American bond. A little bit messy with all the fine print for us to use in this discussion. So let's go to a much simpler bond. This is a Dutch bond, which gets us to the heart of the matter. And on the face of this Dutch bond, what you'll find is the number, which we saw a moment ago on the American bond. You'll find the par value, which is $1,000. The par value only has importance twice in the life of the bond: the day that it's issued in the primary market and the day that it's redeemed in the primary market. Between those 2 points, the par value has no meaning. This particular bond has a very long-term structure. It's more than 5 years, as you can see. And then finally, this bond has a coupon of 10 euros. And what that means is that if you are the owner of this bond, the government of the Netherlands will give you a check every year for 10 euros. So it's a fixed coupon bond. We now use this bond to try and understand how the secondary long bond market anticipates future expected changes in the money market. So to do this, let's start off with this diagram, with this little table here. What the table says is that the par value of the bond we saw a moment ago was 100 euros. The coupon was 10 euros, and the yield was 10%. Now, in the bond market, you never talk about a 10% return. You always talk about a 10% yield. In effect, it means the same thing, but that is the way it is discussed. So then, if we now convert the par value to a market value, because remember the par value only has meaning twice in the life of a bond, the day that it's issued and the day that it's redeemed. Between those 2 points, the bond has a market value which is unrelated to the par value. It depends on the demand and supply of that bond. So the moment you bought that bond, it also had a market value of 100 euros, otherwise you wouldn't have bought it. It has a coupon of 10 euros, and therefore it has a yield of 10%, exactly the same as the previous table, except that the par value has become a market value. Now, if you follow what happens now to the market value of the bond as interest rates on other assets change. So we're going to work in this column here on the yield column where the laser pointer is. We're going to change the yield of other assets and see what happens to the market value of the bond. So if the yield on other assets were to go up, the market value of the bond would halve, would go down. So if the yield on other assets goes from 10% to 20%, the market value of the bond would go from 100 euros to 50. To understand this, let's use a very simple example, that if you want to put money into a savings account, and what you want out of your savings account every year is 10 euros, the amount that you have to put into the savings account is dependent on the interest rate in the savings account. So you want to get a 10 euro return from your savings account. Interest rates are 10%. Clearly, you have to save 100 euros. If you want to put money in a savings account to get 10 euros out of the savings account, and interest rates on savings accounts are 20%, you only need to put in 50 euros to get a 10 euro return from your savings account. And that is, and let's do one more. If interest rates on savings accounts were 5% and you want to get 10 euros out, you then have to put 200 euros into your savings account in order to get 10 euros out, and the yield is 5%. So now if we do this now from the perspective of a bond, and the substitutes that you have from buying this bond relative to other kinds of financial assets, the bond has to yield, risk adjusted, the same as other financial assets. Okay, there is a risk adjustment. We won't go into that. Let's keep the conversation a simple conversation. So when other financial assets yield 10% and your bond has a coupon of 10 euros, your bond is worth 100 euros. Where other assets yield 20% and your bond has a coupon of 10 euros, your bond is only worth 50 euros. And similarly, other assets 5%, 10 euros, your bond is worth 200 euros. So we use this to try and understand how bonds forecast future expected money market rates. And the next slide does this in detail, but I want to talk it through in the context of this table, and then we'll simply record the conversation that we're having here in the next slide. The direction of causation that we currently have in our conversation is from here, from the right-hand side to the left-hand side. In other words, yields on other interest on other assets were 10%, your bond is worth 100. Yields go to 20, your bond is worth 50. But if you are an active trader in the bond market, or if you like, if you are the bond market, which is quite scary, bond market is a very scary thing, you're not looking in terms of causation from right to left. You're actually looking at causation from left to right. Because what you're doing as the bond market is you're looking at future changes in the discount rate. You're looking ahead because you know if the discount rate changes, the yields on assets will also change in the future. So if the discount rate changes in the future, you know the yield on other assets will also change in the future. And you as the bond market need to anticipate those future expected changes. So for example, if you're holding a bond worth 100 euros and you expect the discount rate to decline in the future because of monetary policy objectives, if you expect the yield to increase in the future because of monetary policy objectives, and you do nothing, the value of your bond will decline and you'll lose lots of money. So if you expect yields to go up because the Bank of England is going to change the discount rate because of future expected monetary policy changes, you respond today by selling your bond. Because if you don't sell your bond, you're going to lose money. So you sell your bond And the consequence, of course, is that your bond does go down in price. If there's a sale of bonds, the price of bonds will go down. So it will go from 100 euros to 98 to 97, but at least you get rid of that bond long before it goes to 50. So if you're expecting an increase in the discount rate, you sell your bond. The result of the selling of the bond is the price of the bond declines and the yield on the bond goes up today in anticipation of the future expected change in the discount rate. Hear it again. We're standing here today, we're looking into the future, and we expect the discount rate to increase in the future. You would sell bonds now, today. As you sell bonds, the price of bonds will decline, the yield of the bond will go up, and what that yield is telling other observers who are simply looking at the capital market is that people in the capital market are selling bonds because they don't want to incur the capital loss on their bonds when the discount rate goes up in the future. What is the capital market telling you? It's telling you that the capital market expects the discount rate to go up in the future, and therefore yields on the capital market are changing today in anticipation of future expected changes in the discount rate. Let's go back to the UK and the slide we had a few moments ago. What did we expect to happen in the UK with Brexit? We expect interest rates to decline. So let's do it here, where the laser pointer is. So if you expect interest rates to decline in the future, what would you do with bonds? Well, you'd expect the price of bonds to go up. So take advantage of that expectation and buy bonds. If you buy bonds, the price of bonds will go up and the yield will decline. As an observer of the capital market, all that you and I can see is that the yield on the capital market is declining. But what the yield is forecasting, or what the yield is what the change in the yield is telling you, the change in the yield is telling you that the capital market expects the discount rate to decline in the future, and the capital market yield is declining now in anticipation of the future expected change in the discount rate. That is how you use the capital market. So the slide simply records everything I've said there, so I won't repeat it. Okay, so this is just a recording of what was said there. I'd now like to try and do that in the context of a diagram. Okay, so what we've got, this is the previous diagram that we had. So we've got savings, we've got investments here on this side here, and we've got savings and investments here. Now the mirror image of the savings and investments diagram is in fact the demand for bonds. So this diagram here gives you yields. This diagram here gives you bond prices. Okay, so in the table previously, that's my bond price and that's my yield. So you can see, hopefully using the two diagrams, how both things are going to occur simultaneously. So let's do it. Let's imagine we have an expectation of lower money market rates, exactly what we said we think is going to occur in the UK. So we have lower money market rates. What people who issue bonds try and do is they try and lock themselves into the higher yields. Because if I expect interest rates in the future to go down, if I can lock myself into the yield by selling a bond now, I will increase my supply of money to the bond market. So I will increase the supply of money to the bond market in an attempt to lock into this yield, because I'll issue a fixed coupon. In the diagram on the right-hand side, there'll be an increased demand for bonds. So I'm going to put more money into the bond market. I'm going to demand more bonds with my money. So the change in the supply of savings here, or the supply of money here, I'm supplying more money because I'm demanding more bonds. These two changes are a simultaneous change. That's a money change, that's a bond change. I'm supplying more money, I'm demanding more bonds. On the other side, people who are supplying bonds would not want to actually take the money, because they know, because if you supply bonds, you're borrowing money. If you borrow money now, you'll lock yourself into the higher interest rate. If you wait a bit, you'll get a lower interest rate. So what happens? You decline. You don't actually want to take that money. So the demand for money, the demand for savings will decline. In other words, borrowing will decline. And then on this side over here, if I'm borrowing, people who borrow, they issue bonds. So if I'm borrowing less, I'm supplying less bonds. Okay, watch it again. This is a demand for loanable funds. I will reduce my demand for loanable funds. I won't demand as much, and therefore I won't supply as many bonds. Because if I can wait, I can lock myself into a lower yield. There's the lower yield. So if I expect money market rates to decline in the future, there will be an increased supply of loanable funds to try and lock the suppliers into the higher yield. There will be a decreased demand for loanable funds because the demanders know if they wait, they can lock themselves into a lower yield. And that process results in a fall in yield. In terms of the supply of paper, what happens is that there's an increased demand for paper, there's a reduced supply of paper, and the price of bonds goes up. So what you can see happening in the diagram is we've got the price of bonds going up, and as the price of bonds goes up, it forces down the yield in the capital market. These two things are happening simultaneously. Let's go back.
So we're finally able to turn our attention back to the real world after that long theoretical digression. And if I can refresh your memory, a while back in this conversation, we drew the conclusion that interest rates in Britain, based on thinking about it, are likely to decline. We can now look at the UK bond market to see whether or not the bond market confirms or does not confirm the conclusions that we drew. And the place that we're looking at in the bond market is really just the last few months. In fact, the last month or so is probably better, but the last few months to get a trend. And you can see from the trend in the bond market in the UK that the overall trend that we're looking at inside the bubble is a downward trend, and that downward trend clearly confirms the conclusion that we drew when we did this by looking at monetary policy objectives. So that conclusion holds, and I do believe that it's a correct conclusion. You'll notice that there is a small tail here. There's a small upswing here in yields in the bond market. It's obviously not clear whether that is a trend change or whether that is simply noise. Because if you look at you can look over here, you can see there's noise all through this diagram here. So we simply don't know whether that is noise or whether it's a trend change. And the only way that you find out whether it is or isn't is you watch the space. Now we do the same thing for the US. And you'll notice in the US we're seeing also again the same trend over the last month or so really, which is actually surprising, because everything that we hear about the States is that interest rates will at least stay constant in recent weeks, if not go up. And yet the bond market is suggesting that they're going to go down. We listen to what the bond market is saying. Again, you'll notice in the States, just as we saw in the UK, that there's this little upswing over here in the last couple of weeks, based on the last couple of weeks from the point of this narration. So is what we're seeing in the UK a world trend? It's difficult to know, and clearly, once again, and I'm sorry to do this to you, but I simply don't know, and whether or not this is a change in trend or whether it's noise, we watch the space and we see what materializes. German bonds. Well, German bonds, as you can see, there's been a general downward trend. German bonds actually become negative with, again, that little bit of an upswing there, but German bonds remaining below zero in terms of yield. French bonds showing a downward trend, a bit of a noise there, but there's generally a downward trend. Not zero as was in the German case, but definitely downward trend. Spanish bonds, a downward trend. Japanese bonds, well, okay, Japanese bonds negative, and generally here we see again that downward trend that we're seeing in the US, UK, and again what you're seeing in Japan is that little uptick that we're seeing here. China, we have a flat to slightly down bond yield over the period here, and again that slight uptick. And that is the end of this section. The conclusion we draw from looking at the bond yield is that when we look at the UK and we look at this from a policy perspective in the context of the objectives of monetary policy, we drew a conclusion that rates would decline. By and large, the yields in the UK bond market are holding up that conclusion. What we're also seeing almost worldwide is that yields have been declining, which indicates that there's an expectation that interest rates will decline over the course of, will decline, except in many cases in the last 2 weeks or so, as from the point where this recording is being made, that there's been an uptick in the UK, uptick in the US, uptick in Japan, a little bit of an uptick in Germany. Is it a trend change? Is it just new news is coming through? I don't know. We watch the space. Maybe in 2 weeks' time it will be a lot clearer whether it is just noise or whether it's an uptick. So this has been a long journey we've had together through financial markets. I do hope you've learned something. I do hope it's useful. And remember the takeaway from this part of the course: how do you forecast interest rates? Well, it's fairly straightforward now. You look at the objectives of monetary policy, you look at how each of the variables are performing within the context of the objectives, and you draw a conclusion from that. Your indicator that you use for that is the yield in the capital bond markets, and you use that as a backup. Cheers.